Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And somehow Eric Balchunas isn't here once again.
It's a summer Monday, so
it's a summer Monday. That's a thing in Balchunas land. I'm going to do his stuff today. So let's get to the biggest stories right now in the more than $16 trillion global ETF industry. And we start with U.S. stocks set for a fresh record high as we kick off a very busy week for earnings.
So coming up, we're going to sit down with Jeff Sherman of DoubleLine Capital on how to hedge a potential forced exit of Fed Chair Jay Powell. Plus, in just a few minutes, State Street's Paglia shares her thoughts on QQQ's effort to convert to an open-ended fund. Katie?
Let's take a look at where the money was going. Go with the flow. I think this is what Eric Balchunas does. You take a look at what is attracting money in the week that was. It's pretty interesting. It's a lot of stocks. You can see that measured by SPY, by VU, taking in $3 to $4.7 billion last week. IBIT, Bitcoin, continuing to attract demand here, taking in a cool $2.6 billion, and then a little bit of love when it comes to cash in the form of S-bills. So that's the inflows. Let's talk about the outflows, because this is also interesting. People are buying stocks, but they're selling bonds. Take a look at the top. You have a Vanguard bond fund up there losing $3 billion. You have the small caps as well as measured by IWN losing some love. But then LQD and VB, two other bond funds, also seeing pretty sizable outflows. So an interesting setup here. Buying stocks, selling bonds, also buying Bitcoin, as I mentioned. We were talking about IBIT, but I wanted to zoom out and look at the asset class overall in the ETF wrapper, because as you can see, there's been some peaks and valleys, but mostly peaks. And right now, overall, we're talking about $154 billion sitting in US Bitcoin ETFs. So that's what's on the menu, Scarlett. Stocks, Bitcoin, I had to think about that, and bonds getting sold off.
Yeah, that chart on Bitcoin just keeps going up and to the right. Katie, thank you so much. Joining our conversation right now is Anna Paglia. She is Executive Vice President and Chief Business Officer at State Street. Anna, it is always great to see you back here in studio at ETF IQ. Katie mentioned that people are buying equities, and of course, we're near a record high for the S&P 500. Financials reported earnings last week. Big tech gets us started this week. What are you seeing in terms of flows into individual sectors?
Yeah, whenever we want to test investor sentiment, we always look at flows into sectors, because that gives you a very surgical tool to really make investments in those sectors, in those trends, in those areas where you see growth. So we have seen for the first time this year a rebound of sectors, $2 billion only during the month of July. We see very positive flows into, aerospace and defense, talking about defense spend. We also see really good flows into communication services. You think about all the conversations around AI, artificial intelligence, communication. So communication services are definitely benefiting from that. The only sector that is suffering a little bit is the healthcare sector, because of the political backdrop about healthcare. But all in all, sectors are positive.
It's interesting that you mentioned healthcare, because you take a look at the sector performance year to date. There's not a lot to pick at, but you do have energy down a little bit, then consumer discretionary, and then healthcare is your worst performing sector year to date, down about 4.3%. But we're talking about sentiment. I want to talk about sentiment when it comes to PRIV. Of course, that is the State Street private credit ETF, the first of its kind. And for a while, we were talking about how there was not a lot of interest as measured by flows into this fund. That has started to change just in the last couple of weeks or so. You can see that the green bars are starting to accumulate. And Anna, would love to hear your perspective on what changed. Who is driving those flows?
Yeah, Katie, so I kept telling you guys, give it time, because the way I look at this is very simple. There are products, and then there are moments in time. Moments in time are those funds that change the game. SPY was a moment in time, GLD was a moment in time, senior loan ETFs were a moment in time. PRIV is a moment in time. So people talk about the convergence between a public and private. Guess what? That convergence started on February 28th when we launched the PRIV. PRIV is doing exactly what it's designed to do, which is bringing returns and added yields to fixed income portfolios. And that fund really needed a little bit of track record. We have seen $90 million come in the last couple of weeks from small RIAs, other funds investing in PRIV. So I'm really excited about it. The fund is doing exactly what it's designed to do, is outperforming the benchmark, is outperforming the Core Plus. We look at PRIV as this is Core Plus reinvented, reimagined. And, we are really pleased to see flows that are catching up with the narrative.
So as money is flowing into PRIV, where's it coming out of? Is it coming out more out of equities or out of fixed income?
We see that as a different allocation into fixed income. So it's still part of your fixed income portfolio. But it is, Eric keeps talking about the spicy stuff. So you allocate a part of your portfolio into beta, low-cost beta, traditional asset classes, and then you leave part of your portfolio in something that is more nuanced with additional returns, additional yield. And this is what PRIV is doing, is it has a 20-30% allocation to private assets that are contributing to the outperformance of the fund. So to me, PRIV is just a better way of looking at your Core Plus allocation.
Interesting. So it's not in the beta part of your portfolio. Maybe it's in the more fun, more interesting, more spicy bucket there. I do want to talk about a filing that we saw last week from Invesco. Of course, you used to work at Invesco, making the move over to State Street, now investment management. But Invesco is basically asking to turn the Qs from a unit investment trust into an ETF. As you and I have spent hours talking about, UITs are sort of this dusty structure that was used at the dawn of ETFs. They're not commonly used right now. And one of the reasons why is that you think about the Q's revenue breakdown of their fees. Invesco sees very little of that. So theoretically, that could change if shareholders approve this proxy statement. In terms of other UITs, there's really only there's one that people think of, and that's SPY. When you saw this filing, is this something that State Street is thinking about, trying to turn SPY from a UIT into an open-ended ETF?
Well, Katie, I think we are all going to learn a lot from this filing, from this proxy. But I would say that SPY is operating under a different fact pattern because unlike Invesco, State Street is the trustee for SPY. So that filing to us is interesting. We are going to learn from it and never say never. There is always an opportunity to improve. But right now, we don't look at SPY thinking something is broken, we need to improve on it. It's still the largest ETF in terms of trading volume. It's still the proxy to the market. So I don't think that there is anything broken with SPY, but if we learn something that we like from this proxy, we will think about it.
Okay, I heard never say never, which is not a no. So please keep us updated there. Anna, have to leave it there. Really great to spend some time with you. That, of course, is Anna Paglia of State Street Investment Management. Now, coming up, we're going to talk a little bit more about that and talk about why Invesco is aiming to unlock potentially hundreds of millions of dollars in profit. That's next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with active management. You take a look at the beat rates versus SPY when it comes to both mutual funds and ETFs. And actually, active ETFs are performing a little bit worse than their mutual fund peers. Mutual funds in yellow there both look to be below 50% in terms of their beat rates, but still mutual fund active management slightly outperforming those active ETF managers. We'll keep an eye on that chart. Let's talk about cash. Money markets so hot, and they have been for so long. Even though you have the S&P 500 in the white line there, it continues to go up and to the right, but in a steady state too. Our money market assets also climbing as well. We've been hanging out around $7 trillion for a while right now. If it's not fresh highs on the S&P 500, what is going to motivate people to move out of cash? I don't have the answer. But let's talk about Invesco a little bit more. I love this story. I think it's so interesting. The fact that Invesco is trying to convert the Qs into an ETF. That would unlock that $711 nearly million that ETF earns in annual fee revenue. It's somewhat ironic that this is the most profitable ETF And yet Invesco, which runs the fund, doesn't really see any of it, Scarlett.
How come that is? Why is that? I mean, it doesn't sound like that's a structure that works to Invesco's benefit.
It's so unintuitive. It's a UIT that this is one of the oldest ETFs. It's a structure that was used in the 90s and then kind of done away with, which is why the Qs and SPY are really the only ones out there in a notable way that are UITs. You take a look at Invesco stock, though. The reaction has been pretty amazing in the stock market as sort of traders digest the potential consequences for Invesco. They saw their best day since 2022 on Friday.
So if they want to switch to a open-ended ETF, what's in it for the Q's shareholders? Why would they vote for this?
That's a great point. So Invesco, basically as the carrot in asking shareholders to vote for this, is saying that they'll lower the fee by 2 basis points. So right now it's 20 basis points on the Qs. If this shareholder vote goes through, which is also a very tall order, but if it goes through, then they'll lower the fee to about 18 basis points. But they need a quorum of 50% for that shareholder vote. So that's going to be a big ask.
Yeah, that's going to be a big exercise in getting the word out.
Herding cats.
Herding cats. Still ahead on ETF IQ. We're going to drill down into the bond market with Jeff Sherman of DoubleLine Capital. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas still isn't here, so I'm going to do today's drill down where we focus on one ETF. And in the hot seat today, we have the DoubleLine Opportunistic Core Bond ETF. The ticker there is D-Bond, as I like to call it. Basically, this invests across the fixed income landscape. It has almost $500 million in assets. That's since it launched in 2022. Charges 45 basis points for this actively managed portfolio. Let's take a little look at what it actually holds. This is interesting. 48%, 49% of the portfolio is in mortgages. And then we get into government and corporate bonds as well, but definitely a heavy weighting there to mortgages and specifically to U.S. securities. I want to take a look at performance here. We're comparing this fund to the ag, and you can see that it's outperforming since its inception, up about 6% on a total return basis. You compare that to the ag, to its benchmark, which is only higher by about 2% in that time frame. So active management outperformance for 45 basis points. There you have it, Scarlett.
All right, good stuff, Katie. Thanks for the intro. And joining us now to talk about this fund is DoubleLine CIO Jeff Sherman. Jeff, always a pleasure to speak with you. Deputy CIO, I should say. Yeah. Katie gave us the overview of DBND. Why mortgages? Why does it have such an outsized representation in the fund?
Well, if you look at the mortgage market, it got disrupted really about 3 years ago, and that's kind of twofold. One is there was a big buyer base that left. I think his big name is Jay Powell, right? the Fed's top buying cement. Yeah. He's kind of famous these days. He's made a lot of headlines last week, right? But also banks didn't have as much demand, and they had stepped away. But remember, banks were heavy buyers back in 2020 and 2021. Well, what that's done is that's led to a spread on mortgages, and these are government-backed assets. And today, I mean, there's some risk involved with it of like prepayments and things that get complex. But you can buy current coupon mortgages that trade about 150 basis points over treasuries, right? You can manage that risk. You can manage some of that prepayment. You compare it with lower coupon and older seasoned mortgages. I'm talking about seasoned back from 2020 and 2021. But if you put those things together, you can get a spread that's around 100 basis points or so. Well, that's more than corporate bonds today, right? And so it's not that we dislike corporate bonds, right? We think corporate bonds are a stable piece of the portfolio, as Katie pointed out. A quarter of the fund sits in that today. But really the representation and the spread you're getting out there, why do you need to take this incremental credit risk? And so that's a big reason. And then secondly, there's this other part of the market that's called the non-agency mortgage market, which has a lot shorter life. And so it's a way of managing the spreads and the durations of the portfolio today. And if you look at a lot of our credit book, what you'd see is that it is on the shorter duration side of it. Why is that? One, it's managing the volatility today, but more importantly, it's because that incremental spread, you're just not getting a lot from the corporate market. markets today. And so those mortgages do offer a really good and compelling opportunity.
Well, sticking with mortgages, of course, there's a lot of talk about potential privatization of Fannie Mae and Freddie Mac. I feel like we often talk about it from the equity investment perspective, but as a big holder of mortgages, one of the concerns that's out there is that this could cause ultimately MBS spreads to widen out. What's your view?
Yeah, I'm not sure if it causes, maybe short term, there would be some just forced selling instantaneously, but ultimately it just depends on what that looks like. I don't think a privatization means that existing mortgages will lose that government backing, or the guarantor who steps on the private side would be there. I think the issue becomes, Katie, is new origination, right? And so if you think about it, the timing of this right now, right? You have housing that has highest levels of unaffordability, right? House prices are at all-time highs in most areas. The requirements for the down payments, it's very expensive, right? So the way of kind of proxying that is go to the non-agency mortgage market. Well, in order to do that, you would have to get an incremental spread. So this would make housing a bit more unaffordable when we're already talking about it today. So I feel like the timing is really bad. I don't really understand why we need to do this. We had this kind of quasi-public-private, 20 years ago. Didn't work out very well. And so it is one of the gems in the U.S. asset portfolio. If you think about what the U.S. does well, it is actually the government-backed mortgage market.
Yeah, it's the envy of other countries, certainly. Let's talk a little bit about where you see things headed for the Federal Reserve. You mentioned a guy who's been in the news lately, Jay Powell. Right now, market participants are still counting on 2 rate cuts this year. Does that sound appropriate to you?
It feels right, but it also feels wrong. And so what I mean by that is that I think it's a probabilistic weighted thing. And so the way I view it is that I think Jay Powell shouldn't cut rates today, right? If we look at the latest inflation data, it is starting to tick up a little bit. When you dig into core goods, you start to see some of that tariff pressure appears to be building. Again, it's 1 month, so we won't make a big deal of it yet. But we do think inflation has bottomed for the year. Take a look at break-even spreads, right? The market participants have started to put that in the 1 and 2 year kind of break-evens in a tips market. So when you start to look at where the market is pricing, they're asking about, they're pricing cuts, but they're also pricing higher inflation. And so when I think about Jay Powell and what he said over the last few meetings, right, he's focused on the labor market, right? Because the inflation data isn't supportive of the rate cut yet either. And so I think you would have to see degradation in labor. So when I say it feels right, it's kind of like on the basis of, well, if they have to cut because there's erosion in labor and a weakening economy, and maybe on that side you get to that kind of 50 basis points. So right now we're kind of playing for no rate cut today, but then you have this concept of the shadow Fed, right? What happens on that? And that was floated last week, and that you see how the bond market reacted. It did not like that whatsoever. And so there's been a lot of headlines about trades to put on for that. We have one on as well. We have the same trade everybody's talking about.
Tell us about it. What is that trade?
Well, it's in DB&D, is inside of there, and it's called a steepener trade. So we're long the 2 year and short the 10 year just to play that trade. Now, why would you do that? Well, if you think about the idea, I say no rate cuts. Why do I own the 2 year if there's no rate cuts? Well, let's say, for instance, that someone gets floated out because they get recommended as the new chairperson. They get active on, I don't know, True Social, X, whatever that may be, and they start to pound the narrative of lowering rates. One, does that pressure Jay Powell to lower rates? Potentially. Not sure. We'll have to see how that plays out. But more importantly, the market's going to look through Jay Powell's tenure and say rate cuts are coming as soon as a new person comes in. So that kind of puts pressure there. But we're still talking about inflation. We're talking about tariffs. You're loosening monetary policy while you have that. It probably leads to a steeper yield curve as well. So there's a lot of conflicting signals in the Treasury market. So you saw how many that we own a fair amount of Treasuries. They tend to be in that kind of front end or belly of the curve. We have a little bit for some protection out there, but we've been really wholesaling, ignoring the 30-year part of the market, and we think that part of the market is rife for still more pressure in rate movement upward.
Well, I want to talk about what the catalyst would be there, because I hear what you're saying when it comes to the front end. Basically, 2 year yields fall in anticipation of someone else coming in, but it feels like the long end, the 10 year, the 30 year has been pretty unpredictable as of late. And you think about the steepener trade, that's been breaking hard for years now.
Yeah, but it's all about timing, right? And so, look, we put it on in 2022. We took it off. It wasn't working. It's costly to do, but it's getting less costly. Now, the problem you have now is because the Fed hasn't cut rates, you got to borrow at SOFR in order to do that trade. So you kind of have a little bit of a negative carry. But ultimately, it's paid off. We've had it on for roughly about 9 to 10 months now. We still like it because it helps provide some protection, right? So it's not that we're doing it in massive size to say this is the one trade, it's a one-trick pony in the portfolio. It's a key element there. Further, we own a lot of short duration credit. If rates come down that side, those bonds will rally as well. So there's exposure in the portfolio two ways. But ultimately, if you look at treasuries, they've been very range bound, right? And really range bound, I'll even go back to really, let's say, like the fall of 2022. The 30-year's been having trouble breaking above 5%. It's done it for a couple days. That seemed, we had a big auction, market came in. I think people are trading it though. And to me, I don't like the trade. It's very volatile, right? It's very risky, I think, in that standpoint. And by the way, we haven't even talked about the fiscal elements, right? I mean, for all this talk about Doge and, we're going to cut government spending, I don't know, I saw something about we raised the debt limit by $5 trillion. That sounds to me that they're ready to spend more and more. So I think that you have all this together. You have the Japanese market too. We had the elections, yesterday. So there's just a lot of pressure in sovereign debt globally. And so I think that's why you're seeing what you call unpredictable in the Treasury market on that back end of the curve today.
Is it perhaps just safer to count on a rate cut on June 17, 2026, because that will be after Jay Powell has left, his term has ended for sure?
But why bet on that today, right? And so here's the other thing. So why do we need to take a bet? Right? Why don't we own things that are stable, that earn income? So you look at the dividend yield on something like DB&D, we're close to 5.5%. It's about between 5.25 and 5.5. Those are the bonds we're buying today. And they have short lives, right? So they're going to pay us that cash flow. They have pretty good predictability. And one thing we're trying to manage right now is volatility. So this isn't a market, to me, when we look at valuation, where we need to stretch, that we need to go out and take meaningful risk because you're not really being paid for it. And like you said, it's unpredictable on the rate cuts. So, what happens if there is no rate cut, right? Then you want to own very front-end assets. So we have some floating rate debt that does that too. So when you start to really dig through the portfolio and you look at the construction, there's a lot of things that have an interplay across them. And we're trying to bring stability to investors today. And that's what DB&D was designed to do. And it's designed to go anywhere as well. And look, we've been talking about the non-dollar trade and those type of things too. And look, those will enter the portfolio at some point this year.
And Jeff, we have less than a minute left, so this isn't a fair question at all. But when it comes to duration or credit risk, what do you feel more comfortable taking? Because it sounds like you're not super comfortable with either.
Yeah, we're balanced right now. And so we cut risk back in February on some of the credit positions. Just we thought valuation was stretched. There was increased uncertainty. We still have that today, by the way. August 1 is coming now as a tariff. You see the EU, they're coalescing to talk about how to be retaliatory potentially if there's no deal.
Right.
I mean, we haven't removed these risks from the market. The market's moved on from the risks. So I think they're still there. I think you want to own both, and that's the thing. That's the thing about running a portfolio is you got to be able to balance those out.
All right, that's a great place to leave it. Always great to see you, especially in person. That is DoubleLine Deputy CIO Jeff Sherman. You can read all about this drill down plus the latest in the ETF industry when you subscribe to our ETF IQ newsletter. But that does it for the TV show. This is Bloomberg.